everybody. Alex from Sprintlaw here. Welcome to our August webinar on how to structure your business for growth. Just before we get into the content for today, a quick introduction to Sprintlaw for those who are not already clients. Sprintlaw is an online law firm designed to make legal services affordable, accessible for small businesses. Unlike traditional lawyers who charge by the hour, our model is a fixed fee model. So all of our lawyers work on a fixed fee basis. We give you an upfront quote for your legal services, and we cover all of the different areas of law that businesses may need help with. Everything from, as we're talking about today, getting your business set up and structured, through to contracts, intellectual property, employment law, data and privacy, getting finance if you need help raising capital or with loan documentation, and online stuff as well. Yeah, very happy to help out for anyone that needs advice in any of those areas. We have an optional membership. Most of our clients sign up to it. It gives you access to a ton of features, free documents, free quick calls with our lawyers, some credits to use on legal services throughout the year, an e-signatures tool, and some AI features as well to help you get quick answers to questions. We are planning a major upgrade to the membership in the next couple of months as well. So if you're not already a member, it is a good time to sign up and check it out. A little bit more about us. We've been around for nearly 10 years. We have around 10,000 clients now. We were founded in Australia, but have expanded the company over into the UK and New Zealand as well. And we are one of the fastest growing law firms in the Asia Pacific region. Yeah, would love to have you as a client. We've also added a bunch of free tools onto our website recently, which people may want to check out. This is a new section of our website you can find in the resources section, where we have a couple of relevant tools there on business structuring, some questions you can answer to figure out what structure might be right for your situation. For those thinking of setting up a company, we now have a registration tool on our website that you can use, including a way for you to register a company yourself. There's a few other features you can see on screen now, health checks and stuff with employment law and website compliance as well. And if you are gripped by the inexplicable urge to get some advice on your business structure after this presentation, do feel free to reach out to our team. We're always happy to have a free call to talk about how we might be able to help you. So we'll drop a link in the chat as well. And we're doing discounted rates in connection with this webinar for people that attended for any advice that you might need related to your business structuring. So if you mentioned you attended, yeah, our team should be able to share that discount. So into the content for today, we're going to be talking all about business structuring. So we'll be covering why this matters, what's the importance of business structuring, different types of business structures, sole trader structures versus partnership structures, company structures, and we'll also look at some more sophisticated structures like dual company structures and trusts. We'll then talk about how to pick the right structure for your business, both now and potentially in the future. We'll talk about business names, which are their own consideration in terms of how to set up a business name, register a business name, and potentially register a trademark to protect your name. And then we'll talk a little bit at the end about documents that you might need in addition to actually getting structures registered that may need to be set up or are recommended. So that's the agenda. As I'm going through, Zoom has a Q&A feature, which I'll keep an eye on. Do feel free to ask questions if you have any questions about what I'm talking about. We may have some time at the end for questions as well, but I don't mind answering as we go, as I think it often helps add color to whatever we're talking about. So do feel free to use that. So just to begin, why are business structures important? Well, we have this. Okay, that's hopefully working now. Why are business structures important? So we have this analogy on this slide think of your business structure as the frame of your house. A sturdy foundation is essential for a house's stability, and similarly, the right frame can provide a solid base for your business operations, tax obligations, liabilities, and risk management. It's not a perfect analogy, but I do think it is very core to the way that you set up your business is selecting the right business structure. It underlies the way your business operates. You're going to be building a lot of things on top of that structure. You're going to be having clients that engage with that structure. You're going to have contracts. You're going to have bank accounts. Your furniture, if you will all be in this house. And it can be quite a headache over time to restructure if you haven't got the foundations right. It can be done, of course. You can knock down and rebuild, but it is a non-trivial decision in terms of how you structure your business. And the longer that you get attached to a structure, the harder it can be to restructure as well, which we'll talk about a little bit. So it is an important decision to make early on in your business. And in terms of the types of structures, as a basic point, anyone who's conducting a commercial enterprise in Australia has to register, unless it's a hobby, with the government as a business. And when you are doing that, registering as a business, you have to select a way of operating. And the three most common types of ways of operating are what we have on screen: a sole trader, a structure, a partnership structure, and a company structure. So a sole trader structure is a one-person structure that is very simple and straightforward to set up. It's basically a model where one person is starting a business, just working for themselves, and all they need to do in order to operate is to register ABN, an Australian business number. It's free to do that online if you just trade under your own name. And once you register, you'll have that ABN number. You can go out, you can start conducting business, you can start invoicing clients under your ABN number and collecting income. And then, as part of your personal tax return at the end of the year, you would include that sole trader income. So it's a fairly straightforward way to set up. There are downsides, which we'll talk about in a moment, but many people who are operating one-person businesses choose to use that simple sole trader structure and just go get that free ABN to start operating. We have the partnership structure in the middle. A partnership is very similar to the sole trader structure. It's just for more than one person. So if two or more people decide to go into business together, they can go and register as a partnership. They'll get a ABN for the partnership. They'll also need to get a TFN for the partnership, a tax file number, because the partnership would have its own filings separate from the individuals. But in general, a partnership in the eyes of the law is like two sole traders or three sole traders or however many partners joined together and operating together. They are sort of running the business and operating it together, and they may have a partnership agreement that decides how the business operates. But ultimately, it's the people sort of running the business behind the business. And as we'll talk about in a moment, the liabilities or issues in the business in a partnership are split between the partners. On the right, we have the company structure. This is the structure which many businesses choose, and certainly most sophisticated businesses choose the company structure or a version of it. This is certainly a structure that we as lawyers really prefer for most businesses. A structure when a business sets up as a company is quite different to the sole trader and partnership. What you're essentially doing is you're setting up a new entity, which is a separate legal person from the people that run the business. It has a ACN, Australian company number. It has its own bank account. It may have its own contracts. It may have its own employees, and it's legally separate from the people that set it up. So what that means is, in general, if something goes wrong in the business, a client is upset with the work done by the business, they may be able to make a claim or sue the company, which is a separate person, but they won't, in most cases, or in many cases, have any uh, claim or rights against the people behind the company, the people that own or control the company. Unlike in a sole trader structure, if you are just operating a business with an ABN, but it's just you, something goes wrong in the business, the law does not differentiate between you, the business person, and you, the person, which means if you're a sole trader, maybe you own a house, maybe you own a car, you own some assets, some electric guitars, whatever it is, something goes wrong in your business, all of that stuff could be on the line from a legal perspective, because there is no legal difference between you, the business person, and you, the individual. And similarly, in a partnership structure, whilst you have set up what seems like a joint uh, uh, endeavor with other people, if there is an issue with a client of the partnership, in general, a client could sue the partnership and the people that run it would be in equal parts liable. So if there's two people, they'll be 50-50 liable. So that, but each of their houses, homes, and other assets may be on the line. So the big advantage of the company structure is that it is a separate legal person and you have this concept of limited liability. Companies have this suffix at the end of them, LTD, limited. PTY, proprietary or private, is the most common version of this limited structure that's used by small businesses. Obviously, big companies have just limited companies, they're public limited companies, but for most small businesses, you'd use the PTY Ltd, the private limited company. And the big advantage is the liability of the business is limited to the company. People can sue this legal entity, this separate legal person, but they can't, in most cases, come after the owners behind it. Now, a company has, when it's set up, because it's a separate legal person, it has these two types of human participants. We have directors who are sort of like the mind and the arms of the fictional legal person, the company. It can control the company, it can control its bank accounts, it can sign contracts on behalf of the company. So you can act as the person controlling the company. And then there are shareholders who are sort of like the body of the company. They are the owners of the company, and they're entitled to potentially dividends or profits of the company or money that the company might make, but don't by default as a shareholder necessarily have day-to-day control over the business, although they may have the rights to appoint the directors. So that's how a company works. Now, if you're just a one-person business, you can very much still have a company. You would be the director and the shareholder, so it would just be you that's the body and the arms and the mind. Similarly, if it's a two-person company, both parties could be directors, both could be shareholders in equal parts, and control the business rather simply. So it's not the case that you need to have, a big complex board of directors and a large number of shareholders to be a company. But the structure does facilitate that. And oftentimes as well, while you're a small business, it might be quite simple, a one-person company, a two-person company. As the business grows, maybe you would bring in investors in your company. Maybe you would bring in other directors who you might want to consult to help manage the company. And in that sense, having the company structure is not only beneficial from a liability perspective, it enables you to do more complicated things in the future with the ownership, where when you're a sole trader, you can't exactly split the company and split control. And even in a partnership structure, asking people to join the business means asking them to potentially be personally liable. Now, in all these structures, you can and should consider getting business insurance. And insurance, of course, is a private product that you can buy. And, there's many types of insurance out there: public liability insurance, professional indemnity insurance. Those insurances are a further protection on top of the kind of structure protection we're talking about. So, many people who don't want to yet set up a company will be a sole trader, and they'll get business insurance. And they'll say, okay, well, legally, all of my assets are liable for things that go wrong in the business, but I've got some insurance for the business part. So if someone does sue me, I'll just claim under my insurance policy and no one's going to come after my house. And you might say the same with the partnership structure. And that is a defensible thing to do. And I would consider strongly, if you're operating one of those structures, looking at least some insurance protection. but ultimately it's not as good as the protection you get from a company structure because insurance policies have limits, they have exceptions in all kinds of cases, and the fallback is that all of your personal assets could be liable. So we as lawyers who are often in the business of being risk averse and helping you to protect yourself from risk really like to recommend that company structure as a way of making sure there's that fundamental shield between you and risk in your business. Cash has asked a question. If I have a company, instead of paying myself as wages, would it be better to pay myself as a sole trader ABN? That is a little bit of a mixing of concepts, I think, in the question. If you if you have a company, so I should say, questions like that are probably more tax-oriented questions and things that accountants are very well placed to answer. And for many small businesses, if you don't have an accountant, it can be useful to have one to figure out in any given financial year how to take money out of your business, whether that is in the form of wages or dividends. And certainly, if you have a company structure, there is different ways in any given year that you can choose to, let's say the business makes a certain amount of money, different ways you can choose to get that money out of the business and if it's a one-person company, into your bank account for you to use for various purposes. You can certainly pay yourself a wage as an employee. You can pay yourself dividends. There are various ways to sort of transfer the money out of the company. And what makes sense will depend on your personal circumstances, the amount of money that the company's made, how you want to handle taxation, and so on. If you're a sole trader, it's usually quite straightforward. The sole trader income is treated as part of your personal income, and the usual personal income tax rates apply. You can claim business deductions as a sole trader. But in general, it's just part of your ordinary tax return, whereas the company has some of that flexibility. There's a company tax rate of a certain amount. There's also the ability to pay out money, again, as wages or also as dividends, and they each have different consequences. So for many people, the company structure at a certain revenue level becomes more tax effective for them. And that is a reason many people choose the company structure. And again, I got a bit of a table on that in a moment. But in general, whether it's better or not to pay yourself in a particular way sort of depends on the situation and the amount of money that you've made. And again, always useful to speak to an accountant because the answer may change from year to year. And many small businesses will, in year one, only pay themselves dividends. In year two, they'll pay a wage and so on and so forth. So it can evolve over time. So so those are the kind of basic structures. Now, here we have the more sophisticated structures for people that have set up a company and want to understand are there additional things that you can do. So these are three sort of more sophisticated company-oriented structures. So we talked a lot just now about when you have a company structure, this concept of limited liability, which means if there are issues in the business that's run by a company, in general, clients, employees, if you have them, can make a claim against the company, but there's this limited liability. They can't, in general, make a claim against the people behind the company, the founders, directors, and shareholders of that company. What can happen over time, of course, is that your company can become very valuable. It can become possibly even more valuable than your personal assets. And so not only do you want to protect your personal assets, you might want to protect some company assets from being on the line to every client. And so we have in the middle this thing called a dual company structure, which many businesses choose to set up. And what they essentially do is they'll have a holding company and an operating company. And the operating company is the one that goes out and does business and signs contracts and employs people and does all the risky things that you might do in business and hopefully doesn't, but may make mistakes. It's owned by a holding company, and the holding company holds the valuable assets of the business. That might be significant cash. That might be other assets that the company owns if it owns any property. That might be its intellectual property, particularly for technology companies. That can be significant if there's software or other innovations that they've created. Those key assets get held in the holding company, and the holding company is like a safety deposit box. It just sits there owning the assets. It doesn't do anything. It doesn't otherwise contract with people. And it owns the operating company that goes out and does all the risky things in business. And that means there's this double limited liability protection. If something goes wrong in the business, customers may be able to make a claim against the operating company. Employees may be able to make a claim against the operating company, but in most cases, the liability will be limited to this legal person, and it cannot pierce through to this holding company. It certainly can't pierce through to the people at the very top, the owners of the business. So it can be a very useful structure. It seems like the kind of thing that's overcomplicated and might only be done by larger businesses, but we do actually recommend a lot of businesses consider setting it up early. There is a bit of additional cost, but having it from day one is much simpler than having a mixed company that both owns all your assets and has signed all kinds of contracts, and then trying to split later. You may not easily have a way to end up with a clean holding company. Either you have to introduce a holding company at this level above the operating company, which means all of the owners would need to sell their shares to the holding company, which can trigger some CGT or tax obligations, or you need to introduce a new operating company below your single company, which means your holding company is not that clean because it has been operating and doing things and signing contracts and may one day be sued for something that happened a few years ago. So having the clean holding company from the beginning can be very useful. There's other additional benefits to having the two levels from early on. If your business grows and expands, whether it's overseas or into new areas, you have this advantage where you can set up multiple operating companies and effectively silo your risk into different legal persons. So to use the example of Sprintlaw, we have Sprintlaw Group, which is our holding company, and we have Sprintlaw Pty Ltd, our Australian operating company. We have Sprintlaw UK, which is another operating company. We're setting up Sprintlaw New Zealand, which is another operating company. So what that effectively means is if there's an issue over in the UK with our UK company, the UK client decides to make a claim against us, the UK business will be liable, but our Australian business is a separate company. So the risk would be siloed into the UK business, and it certainly wouldn't flow back to the holding company either. So you can think in your business, if you may have different business lines, you do 3 or 4 different things. Depending on how substantial they are, there can be an argument for setting up multiple companies for them. And similarly, if you expand internationally, it can be useful. And so having the two levels makes it easy to add on later as you grow these different companies. You can just register a new company and set up business there. Whereas if you're just sitting at the one level and you plan to expand, it can be difficult. So that's the big advantage of this dual company structure. And many of our startup clients who are sort of small businesses now, but have aspirations to be very large businesses, will do dual company from day one. Many growing small businesses will do dual company from day one. Again, if you don't intend to really grow the business in the way that I'm sort of describing, it can be overcomplex for what you need. But that's the reason that people do it. And again, if you are going to do it, there are significant advantages to setting it up early on. Finally, on the right, we have the trust structure. This is, or at least was, a very common structure for the last few years for businesses who were setting up. And you can see in this structure down the bottom, it's the same as a dual company. That's not really the point. In this structure, you can see up at the top level, we have the ownership or the shareholding of the business owners set up a little bit differently. So in these first two models, we've said that the founders of the company are the shareholders themselves personally of the business, and potentially any investors that may or may not be in the business. In this model, the founders have set up a company, a trust company, in between themselves and the actual business company. Now, why have they done this? Well, I've talked a lot about how companies are sort of like a shield from personal liability. So something goes wrong in the business. If the business is a company, people can come after the company, but they can't necessarily pierce through and come after the owners. So you can see in this model, these founders in one and two are protected quite well from issues with clients and potentially issues with employees. But at the top level, they could still have disputes between each other. And there's no company between founder one and founder two. They are, joint shareholders, joint owners of a company. And so there is still risk if founder two decides to come after founder one for some business dispute. Again, there can be personal liability there because no company sits between them. So having a trust company in between your shareholding puts a sort of personal third layer of protection. And so you can see founder here is very well protected. There's that all the way down here. You have the employees and the clients that may try and make a claim against the operating company. They'd have to pierce through a few layers of defense to get to the founders, and then even between founder one and other founders and investors, there's that extra shield of a trust. So that is one of the key reasons lawyers, at least, like to recommend holding your shares through a company or a trust company. Now, the reason that we use this term trust instead of just like a normal company is a trust is a type of structure that you can use where it gives you the ability as a company to distribute the money that comes out of a business not only to one person who owns it, but potentially to multiple beneficiaries. And so this fact had been used for many years for businesses and business owners as a method of more tax effectively taking money out of the business rather than just having it as a company. You could potentially have yourself as a beneficiary, and then other people, other members of your family, for example, as beneficiaries and flow funds out of the business to various other people. Recent changes to the budget have proposed putting a minimum tax on trusts, and this hasn't been passed into law yet, but it's been proposed that it will be passed into law in 2028. And so many of those tax benefits I was just alluding to under this model would be weakened and potentially wound back. And so if that goes through, I would expect it may be the case that people don't use trusts anymore and they may just use normal companies to hold their shares. From a legal perspective, there's still an argument for having a trust or company hold your shares because, as I said before, it's about that shield and risk protection, and that's always why lawyers recommended it. Many accountants, as I understand, are figuring out whether they still recommend people use trust from a tax perspective. So kind of need to watch that space in terms of whether you would bother setting up this structure yet or just sticking with owning it personally. As I said, there are those additional risk advantages, so it's just something to consider. Another little risk to mention. For those of you who are, sorry, I've just noticed we had a couple of questions before I jump into ESIC. Jason's asked, are there tax benefits using a holding company or just liability protection? Look, in general, and again, like I can't really speak to tax because that is something that is more in the realm of accountants and tax lawyers. So I can more talk about from a risk perspective. But in general, the primary purpose of the dual company structure is not about tax. It's about that two-layer of risk protection. That said, having the two layers of companies can have different tax outcomes. For example, if you have one business that operates everything you do, all of its income would be looked at together, taxed together, and its expenses would all be pooled. If you split it into multiple companies, the expenses would live in different companies, the income would live in different companies, and the tax result for each company would be quite different. And so that fact has various implications and could result in different tax results. And certainly, if you start expanding internationally, it becomes quite significant in terms of what expenses you decide to put in business A versus business B. So there can be tax implications, in some cases benefits to the multi-company structure. Um, but again, what they are is totally dependent on whether it's an international operation, how you decide to structure the business, and so on and so forth. The key reason that we're sort of talking about it is more from that risk perspective, and I don't usually see, at least for small businesses, that being the key reason people use the dual company structure. That's more for larger businesses that might start thinking about cross-jurisdictional issues. For smaller businesses, it's if we're thinking about tax, oftentimes people will move from sole trader to company because it becomes more tax effective. And prior to these new changes, people would also move from company to company plus trust. And those are the two most common things we have seen from a tax perspective, except for larger businesses. So that's really, if you're interested in the tax element, sort of what people have historically done. And another question, can you explain a little bit more on that aspect of trust and recent changes? Yeah, look, the budget, I've got this in the corner, has proposed a 30% minimum tax on discretionary trusts from 1 July 2028. And what that means is, and again, this is more the realm of accountants and tax advisors than lawyers. So we at Sprintlaw don't have strong views on what people are going to be doing from a trust perspective post July 2028. So I can't speak to this in great detail, but I can give you a little bit of a sense of what this 30% minimum means. In the past, you may have a company that was owned by a trust. Money might flow out of the company to the trust. The money would then be distributed to the beneficiaries of the trust. So if you were the only beneficiary, and let's say a certain amount of money flows out of the company, that flows from the trust to you personally, and you would then pay personal income tax on the money that flowed through. What many business owners would do is that they would attach multiple beneficiaries to a trust, some of whom may not have earned income that year or may have had low incomes. And effectively, instead of putting all of the money from the company into a particular founder's personal income, which if significant money was made could result in the top marginal tax rate of 47%, they would split the company's money between multiple people, try and use different tax-free thresholds to reduce the effective tax potentially payable on money that flowed out of the company. And it may be then that rather than one business owner paying themselves an additional X tens of $1,000s at the 40% tax rate, it ended up being split between multiple beneficiaries, and lower tax was paid on the distributions. The new budget is basically saying you can try to do things like that, but we're going to impose a flat 30% minimum tax rate on trusts, which makes it much more difficult for people to use these tax-free thresholds that they would use of various people. And so you can see there now that they're kind of looking through these arrangements and trying to sort of increase the tax. So the cost and complexity of the trust may not be worth it anymore, given that there isn't this potential tax saving for many. Although again, as a lawyer, I still think there is this benefit, at least, to holding your shares in a company, even if there isn't this tax benefit, if that makes sense. And Yolanda's asked a question: what implications are there for you if you are trading as a sole trader internationally? Yeah, there are lots of implications. In most international markets, there are similar laws to Australia, which basically require that if you're conducting an operation in that region and it's not a hobby, you're required to be registered there. Many small businesses who run e-commerce stores and stuff will operate online, and they will fly in the gray zone, and they'll ship sales to people internationally without having a registration. And when you're operating at very small scales, you might get away with that from a low practical risk perspective. But if you end up with a serious operation in another market, you're meant to have a business registration there too. And that registration, you may not be able to be their equivalent of a sole trader because you're not residing in that that country or that market, and really you should potentially be paying taxes there and so on. So it can be a lot simpler to have a company structure with either a branch or a subsidiary in those markets. And that's the most compliant way to run a business internationally. The other issue, of course, as with any sole trader business, is if you start selling things to people overseas, your liability is certainly personal to them. So they could make a claim against you in another country, and you could be liable in that country. It might be difficult for the courts of that country to enforce anything against you if you are not registered there in any way. But of course, that can create issues and risks and so on if you want to attend that country in future. So it is again not that uncommon that people are sole traders, particularly with e-commerce businesses, selling some stuff online overseas. And even though there are all these risks I'm describing, there may not exist in practice at small scales. But we generally advise businesses that are seriously operating internationally to look at a proper company structure, look at local registrations, and sort of do it right. And certainly as those businesses scale, that's sort of where they usually end up. And then one more question here on structures is which structure is best if you intend to raise capital from private investors at different stages of the business? Well, the first comment I'd make on capital raising from investors is you pretty much in most cases want to have a company structure for capital raising. Now, if you're just getting a loan, like a family loan or a bank loan, you don't have to be a company. You can potentially do that as a sole trader or a partnership. But if you want to sell a stake of your business, you want to do an equity fundraise, you want to sell shares in your business, by default, you therefore have to have a company so you can split the ownership stake because you can't sell a share in a sole trader. And it's difficult to sell a stake in a partnership. So the company structure is certainly the minimum that we usually see for at least equity capital raising. We generally recommend if you're going to raise any serious investment, you consider a dual company from day one. Again, you might have substantial investor cash. You may not want to put that in the same bank account that you're going out and doing risky things with. And again, if you intend to expand the business, those two layers and all of those different things can be beneficial. So for most businesses, even raising their initial funding round, we recommend they consider the dual company structure. Another option is to do a single company structure and then wait until you're a little larger to migrate to the dual company. And you could still raise investment that way if you're small, very small, not raising much money and don't feel that you could afford the dual company structure. But as I mentioned earlier, the complexity of changing later, potential tax risks of changing later versus just having it all set up from the beginning and the cost of that, my view would be do consider the dual from day one. And again, similar with the trust, prior to the budget, I probably also would have recommended that you do the trust on day one as well, because moving from dual to trust means founders have to sell their shares to a trust company, which can have tax implications. So it's cleaner to have the whole structure set up. Again, we'll wait and see what happens with the budget. And if you need to do something in the meantime, I'd consider getting a little bit of tax advice. But yeah, it may not be as, at least from a tax perspective, attractive to do the whole trust structure from day one for raising investment. But certainly you would consider the dual. In the case of Sprintlaw, we've raised funding. We began for our first 6 months as a single company structure, not doing much. And then around the time we thought we might raise investment, we swapped over to the full trust structure. And I'm glad we did that early on because it was saved a lot of headaches later when the business got more complicated. So that gives you a sense of what people would often do. Just a note, and this is more specific for startups, on ESIC. This is a bit of a specific issue, but there was a case that was decided in 2024, which slightly is a little asterisk to what I was just saying about dual company structures. So again, this is more for startup companies that want to raise investment, and actually relates, in fact, in some way to the question that was just asked. For most startups, we would recommend this dual company structure because it's just much better from a risk perspective. A recent case in 2024 with the ATO has said that dual company structures can be at risk of not qualifying for something called ESIC, which is a tax incentive that investors get in innovative companies. Investors basically get a protection and a reduced tax rate on investments in risky innovative companies under this ESIC scheme. It applies to a sort of pretty narrow set of companies when the investor invests when their revenue is below a certain level and they meet a certain innovation test. But there was a case where someone had used this holding company structure. The investor had invested in it thinking they were going to get the ESIC benefit. And then the ATO later on said, oh, no, you don't actually get the tax benefit because you owned the holding company, but all the innovation was happening in the operating company. The holding company wasn't doing anything. And that was challenged and was different to how most lawyers and accountants understood how this structure worked. Still unclear whether that could have been avoided if there had been better contracts between the companies and whether a slightly different structure that was similar to this could have solved the issue. But if you are thinking of getting ESIC, and again, that applies just to that class of startups that want to provide a tax benefit to those early investors, you might want to get some extra advice before you settle fully on the dual company structure. So that was a lot of information on different structures, but we have this nice table here that hopefully summarizes for you how you might think about it. We have our sole trader, partnership, company, dual, and then trust, and the various advantages. You can see that it gets greener as you go to the right from a control, liability, capital raising, continuity, and tax perspective. The cost, of course, gets more and more. So that is the trade-off. Do you want the great structure for the additional cost, or are you going to just go cheap and simple? And we'll talk a little bit about restructuring in a moment because that's an obvious question. Can I start off simple and make it more sophisticated? I've touched on that a bit already, but we'll talk about that a bit more. But I think to give you a flavor for what the actual costs are, because we've just got dollar signs here. With Sprintlaw, we would register a company for I think it's around $900, including the ASIC fee of $630. So, you're paying an additional, let's say around $300 on top to get a company registered. You'd have to do a separate tax return each year for the company and a renewal fee. So you're looking at, let's say $600 a year to run a company as opposed to a sole trader. So you got that $1,000 setup, the $600 a year. Cost may obviously vary depending on who you work with. And then maybe some other flow-on costs. So, maybe you would budget $1,000 a year or something for the company administration. So that's kind of company structure. The dual, you got to set up two. If you bundle them together, it ends up coming out to $1,700 or something like that, including government fees. Maybe let's say $2,000, and then again, you might increase those compliance costs each year by an extra $500 to $700. So $1,700 a year. So $2,000 to set up, $1,700 a year on the dual, and then the trust. You've got if you were a one-person trust company, you've then got an additional level on top of that to set up the company and the trust. So you may be looking at more like let's say $3,000 setup and $2,500 a year in maintenance fees. So that gives you a bit of a sense. It's not tens of thousands, but it's not nothing either. So that's the cost of operating these structures. And you've got to find like the right middle ground for your budget and your scale of business while considering all of these different factors. So hopefully that's helpful. And again, many people do choose to just start with the company structure or the dual company structure. So that may be a nice middle ground to get many of the benefits without prohibitive costs. There are other types of structures out there. There are charity structures, things called companies limited by guarantee. There's not-for-profit structures. There's incorporated associations. There's unlisted public companies. There's crowdsourced funding structures. So these are more niche structures used for very specific types of business. I'm not really going to go into them in great detail today, but Sprintlaw can certainly help, particularly with charity and not-for-profit structures. And again, there are different models you can use depending on the scale of your charity or not-for-profit. And you can in some cases get, if you're a charity, what's called DGR tax status, which give people tax deductions for donations that they may make. So that's another structure, but it must be the case that your organization does not exist for profit and exists for some not for profit purpose. And there's a registration process for aspects of that as well. Um, just noted a question for Vijay. Are there R&D tax benefits for startups in technology space? Um, yes, there are. The Australian R&D scheme is a pretty substantial grant scheme that many technology businesses use. It doesn't directly relate to business structures. It's again more of just something to seek some tax advice on. There are R&D consultants out there. If you just search online, R&D consultants, you'll find many agencies that specialize in helping companies with R&D grants. Many of them operate on a commission basis, so you would only pay them a percentage of the amount that you would claim. So for those interested in learning more about R&D, I would just suggest reaching out to a consultant and seeing if what you're doing meets the threshold for R&D. Again, the recent budget has changed the R&D scheme, and in many cases reduce the amount that businesses may be able to claim. So it'll be interesting to see. And that's all from 2028. And hasn't been formally approved yet, but it'll be interesting to see what that does to the space in terms of how many people are using the R&D grants. But as it stands, a substantial number of technology startups do look at the R&D grants, so worth investigating. So in sum, I think when you're choosing a structure, like there's, as I said, a lot of information. Just think about liability, first of all. How risky is your business? Even if you are a small scale operation, if what you do is very risky, you probably want to be extra careful with your liability. I still remember we had a client of ours who was doing indoor skydiving, and we were discussing the business structure. They were kind of operating as a sole trader, and I said, "Oh, I've just started. I don't have much income." And the advice was, "Well, the nature of what you do is so risky that it's probable that someone's going to get injured at some point, and you may really want to have that structure protection versus even a larger business that is doing just sort of low risk advisory work." It may be the case that they can operate for a little bit longer because the probability of them, being sued by a client might be lower. But for all businesses, the longer that you exist, all it takes is, one incident to happen, one bad incident to happen, even if, you've had years of no incidents, and then that can be the time where you're going to wish that you had that company structure. And that protection. So think about your business, think about the risk, and think about how well you want to sleep at night. And that could be one big reason to think about the company structure. Balance that, of course, with cost and complexity. The sole trader structure, the partnership structure are fast, easy to set up. Think about control. Are you going to be adding in more people into your business one day? If so, having that more company-oriented structure can be cleaner and can allow you to do more sophisticated things. Those that run the business don't necessarily have to be those that own the business. Are you going to raise funding? And then obviously these tax questions that we've kind of touched on as well. So now I just want to talk a little bit about changing structures because again, many of you will already be registered as a business and be thinking, maybe I should swap to a company, maybe I should swap to a dual company. When's the right time for me to do that? Is it when I get to a certain size, when the money I'm making comes to a certain level? Is it when I plan to do something with capital? For better or worse, there's not a single answer to that question. It's not like, okay, when you start making over $1 million a year, you should become a company. It's relevant, of course, because the amount of income you're making from at least a tax perspective can be significantly treated significantly differently as opposed to whether you're a company or a sole trader. So it is certainly the case that larger businesses are far more likely to be companies. And so you should think as my business grows as a measure constantly, we're growing. I should consider if you haven't already moving to the company structure, but there's not a single number. It just becomes more common. I think liability is a really big reason, which I just touched on. I think if you are operating a serious business, it's what you do all the time, and you want to grow it. Just having that mixed in with your personal assets and your personal life really um, uh, can um, can be risky, and there is a big argument for just keeping them completely separate and having that company layer. So uh, for me, it's not only about revenue; it's about how risky is your business and how serious are you about your business and how important is your business. And if it is like a experimental side hustle consulting thing at the moment, it can be totally rational to have the sole trader. If it's just you and you think it's very low risk and you're not earning tons of income and you um, really don't want to bother with all the complexity, I think it can be rational to be a sole trader. But I think as your business professionalizes, it can be a good moment to switch to that more company oriented structure. I also want to think about succession planning. Do you want to sell the business? Do you want to pass down the business to someone through a will or otherwise? Again, having it all packaged up in something like a company can be a big advantage for passing on the business to someone else or selling the business. When it's a sole trader or partnership, it's all mixed again together with your personal assets, and it becomes difficult to identify what it is, in fact, that you might be selling or passing on in the future. And then, of course, the tax efficiency point. What does it feel like to change your business structure? It depends on what structure you're changing to, but if you are looking at moving from the sole trader or partnership to that company structure, this is a little bit of a roadmap of how it would work. You would choose a new structure, say, okay, I'm going to swap to a company. You then would prepare the legal documents, get your constitution together and so on, and register the entity. Um, uh, if you work with someone like Sprintlaw, we would do these for you at the same time, register and give you all the documents. There are legal documents that you need as at least once off, and then need to keep up to date when you register a company. So you want to make sure that's done. You then get your ACN. Your company would get its own ABN as well and tax file number because it would have its own separate tax return. So you get three numbers usually when you set up a company that's trading. You have the ACN, the company number, the ABN, the business number, with the ATO, and the TFN, which is the tax file number. So it's a lot of numbers. So you register that. You then would move the assets across. You'd have a contract saying, I'm moving all of these things that I own personally over to the company. The company now owns it. And you'd usually have a simple contract of transfer that moves across all the assets. If you have employees or clients or suppliers, you would need to notify them and change your contracts. You are no longer employed by, entity A or employed by or by the sole trader or the partnership. You're now employed by the company. You are now, dear client, you are now going to be contracting with the company. Can you please agree to our new terms? Same to the suppliers. You also want to make sure that the company is complying with employment laws if you start employing people, and other industry specific laws that might apply. Of course, that may have been the case before, but as you formalize the business, it could be a good time to review that. And finally, your bank accounts and your payroll if you have it, and potentially your signage and all the stuff on your website and so on. Just update the operational systems to be under the company. So it's not rocket science, but there are a few administrative steps, and you can see just looking at this chart that the longer that you wait, the more complicated it can become. So doing it early is a little simpler to swap things around, if that makes sense. We had a question: what's the process of selling shares or transitioning from a private to a public listed company? A public listed company is a structure for quite large businesses, usually, with some exceptions. And in general, to be able to become a listed public company, to actually list your company on, for example, the ASX, and allow anyone in the public to buy shares in it, you'd need to meet some pretty significant asset and revenue thresholds. So I think it's something like $10 million in assets or something along those lines. So it's something that larger businesses consider, but small businesses very rarely will look to list unless they're like a high growth startup, or there are some things they call backdoor listings or reverse listings that some particularly mining companies often use. But in general, it's for larger businesses, is probably my first comment. And the second is you would do, in general, what's called an initial public offering, where you spend a lot of money on lawyers, getting everything together, disclosing what it is that your company does, disclosing risks to the public, passing all kinds of compliance thresholds, and then you'll sort of try and float the company on a stock exchange. So not that relevant to small businesses, so I probably won't go into too much detail, but that's high level what it involves, and it can be an expensive process, but a great way to raise funding for larger businesses. Now, just quickly touching on business names. In whatever structure you choose, sole trader, partnership, company, or otherwise, you want to pick a name for your business. Now, when you set up a company, you might pick a company name, but there is a separate registration in Australia for business names, which is separate to your company name. So, for example, Sprintlaw is companies are called Sprintlaw Group Pty Ltd or Sprintlaw Pty Ltd, but we have a business name registered, just Sprintlaw. And in Australia, it's a legal requirement if you are going to publicly trade and market your business and present yourself to the public under a name other than your entity's legal name, whether it's a sole trader, that's like if it's not your own name, or if it's a company, if it's not exactly with the Pty Ltd, your company's name, you need to register that business name with ASIC. And the public policy reason is so people can see that, look up the registration and see, is this a real business or not? So pretty much everyone that has a trading name needs to register a business name. It costs a little bit of money. I think it's $80 a year or a little bit more, and maybe $150, $180 for a 3-year registration. It's just an administrative step that you need to do. But if you haven't done that already, it's important to register your business name. And if someone else has an identical business name, you actually can't use that name because, again, you may confuse the public. They don't know if you are, which one you are, if that makes sense. In addition to the business name registration, people think I've registered my business name, I therefore own my name and I'm the only one that can use it. A registered business name, for that little fee that I mentioned, does not give you any brand or ownership rights over that name. It's just a registration that you have to do legally if you're going to use a name that is not your own. A trademark is a separate registration, which gives you exclusive ownership over a particular name, and it doesn't have to be a business name. It could be over a product or a phrase or a logo. And it's its own registration. You do it with IP Australia, a separate government body. You register in an industry, and that is the one that gives you the exclusive rights to your business name. So, for example, in the case of Sprintlaw, we have Sprintlaw Pty Ltd, the company. You have a business name, Sprintlaw, and we have a domain name, sprintlaw.com.au, and we also have a trademark for Sprintlaw, for our logo, that little S shape that you might have seen, for our key phrase, business legals made simple. So those last 3 things that we have trademarks for, they give us the exclusive right to use the word Sprintlaw, the name Sprintlaw, in Australia, in association with the legal industry. So someone can't come along and start another business called Sprintlaw. They can't launch a product called Sprintlaw. They probably couldn't start a business called Sprint Legal or Sprint Lawyer because it's too similar. So this is the advantage that a trademark gets you, and it's a really important registration. A lot of people think they own the brand because they did that ASIC registration. They don't realize that they don't actually own the brand. In fact, they don't even realize that someone else might own the brand. You might think, oh, I got through ASIC, I must be fine. You can imagine the example of like MacBook. You might start a company called MacBook Pty Ltd and then go out there and call your business MacBooks. Apple doesn't have a company called MacBook Pty Ltd, but they own the trademark for MacBook, and they could potentially make a claim against you for infringing their trademark and their brand, even though you managed to get that business name registered. So they're different things, the trademark and the business name. And if you don't have one already, we generally recommend getting that quite early on. Certainly, again, for the example of Sprintlaw, first 6 months, we did company registration, we did shareholders agreement, which we'll talk about in a second, and we did trademark. Those were our big 3 things that we got protected because we did not want to be building goodwill in the business in a brand that we may not own. So I do recommend people get that trademark sorted early on. It's probably the number one most missed thing by small businesses is the trademark registration. Conscious we're at time, but I will go a couple of minutes over. There's only a couple of slides left. Uh, just quickly on um, directors' duties. When you set up a company, I kept using the word in most cases, you won't be personally liable. I didn't say in all cases. If you set up a company, but you breach what the law calls the director's duties, you can, in fact, have personal liability despite having the company. The company is not an absolute shield. It's an absolute shield in most cases, but if you don't follow these duties, you don't act in good faith, you don't run the business in a way that's to its financial detriment, you don't try and sell while the business can't afford to pay its debts, or what they call insolvent trading. You don't use the company to advance personal interests. You don't misuse your position in the company for personal gain. You keep proper financial records. You don't break the law. As long as you do those things, you are in general protected from personal liability. But if one of these duties is breached, um, another owner of the company, another shareholder, potentially clients and other third parties can what we call pierce the corporate veil and come after you as a person. So it is important to realize that when you set up a company, you do have these important duties and you have to act in accordance with them to make sure you benefit from that limited liability. And ASIC has some great pages explaining sort of what they are and what they mean in practice. But with a bit of training, you can understand them and make sure that you don't breach these duties. Um, and then finally, and I touched on this earlier, once you've set up your structure, there are documents that we recommend you put together, some of which you have to put together, some of which are recommended. If you're a partnership, you at minimum just need that partnership agreement between different partners. It's not actually a legal requirement, but many banks require there to be one in order for you to open a bank account. If you set up a company, there's a few documents that are required by law. In general, it falls under what we call your company register. The Corporations Act requires that you maintain a document somewhere showing who's the directors, who owns the shares, and et cetera, et cetera. Are there any debts against the business and so on? We also generally recommend setting up a company constitution that explains how the company's decisions are made and what directors do and what shareholders do. We strongly recommend if there's more than one owner setting up a shareholders agreement. This is an in-depth contract between the owners that covers what happens if one person wants to leave the company, one person wants to stay, what if there's a dispute between owners, how are investors brought on, what if one wants to sell, the other doesn't, et cetera, et cetera. And it's a very important contract to reduce risks. It's sort of like a prenup for a company for owners, but then also when you bring in investors, they can agree to that too. Not required by law, but extremely strongly recommended for anyone running a company with more than one person is the shareholders agreement. And then there could be directors agreements too, to protect directors from risks if they do suffer personal liability as a result of operating the company. And there can be some licensing documents as well if you use that dual structure and you want to hold some things in one entity and some things in another entity. If you go down the route of having the trust, there are some additional documents, including a trust deed, and in some cases, a unit holders agreement if you use a unit trust, which we didn't really touch on today. But again, many times, if you set this up through a lawyer or accountant, they will just handle that documentation for you. And it's the same with the company structure. If you set this up with a professional, they can help you handle a lot of these documents. It's very standard stuff as part of the setup, if that makes sense. So that was all of the content I wanted to cover. I'll answer some questions for a few more minutes. But for those of you dropping off, I hope that you have found this presentation useful and given you a little bit of insight into how to think about structuring. As I mentioned, if you mentioned you attended the webinar, our team would be able to give you some discounts for, I think, the next couple of weeks on these services, things related to your business structure. So do feel free to take advantage of that. And we run these every month. So please feel free to come along again if you found this useful. You can register via our website, or if you're a member, we send out email reminders and about when they're happening. So thanks so much. And yeah, I'll just have a look at these questions here. So we've got a question from Yolanda. Is it hard to apply a business name as a sole trader after a period of time? Not really. No, it's quite straightforward. You can do that on the ABR website. Sprintlaw is going to launch a tool actually probably in the next month or so on our website, where you can also just register for a business name that way, and we'll make it really straightforward. Many people realize after a year or two that they hadn't registered their business name and they go ahead and just do it after the fact. So I would do it because if you are trading under a name that's not your own, you're technically breaching one of the requirements of the business laws. So I would go ahead and register it. And you also want to make sure that someone else doesn't already have it, because again, exact matches can become a problem, and you might have to use a different business name. So again, if you just Google it for now, register a business name, and try and find the .gov.au website, you can do it that way, or there are other vendors out there like Sprintlaw who can handle it for you. John's asked for a PTY Ltd company with two co-founders, but only one of them is a director. Does the other co-founder get viewed as a shadow director by ASIC? So not necessarily. A shadow director is that term is usually used to describe arrangements where one person is sort of not officially a listed director of a company, but there is a arrangement, oftentimes a contract, where they effectively have control over the company. So whether someone is a shadow or director or not turns more on the nature of the relationship, and rather than just the mere fact of them being a co-founder. And there are many arrangements where a co-founder is not, it's just simply not exercising that level of control. However, if in practice the co-founder is acting as a director, the Corporations Act does have some laws around what they call de facto directors, who actually act as if they are a director, control the bank account, and so on and so forth. And again, if you have that contract that I mentioned, where it's actually the case that they can exercise control over how the company's operated, then there can be this risk, but it's not black and white, and it's the language in the Corporations Act is quite subjective. So yes, there can be some risk as the answer to your question, but it's not automatic. And what is the implication of that? Well, the main implication of being a shadow director is that those directors' duties I mentioned can apply. And again, the other co-founder could have some residual personal risk if they are effectively acting as a shadow director and they breach a director's duty. So that's sort of how it works, and it is a consideration. If there's a good reason that they're not a director, and one of them is for risk management, then one should be careful about the extent to which they are exercising control, and maybe something you want to get a little bit of advice on like what procedures you might want to put in place to reduce those risks and make sure that they're not becoming one of these de facto directors. Another question, what's the difference between an executive director employed by the company and a director who is the founder in terms of liability? So yes, this term director, which is in the way I've been using it, is the legal term director, which is embodied in corporations law, and it is a thing where you have formal legal duties, and you're listed on the company as a director, and you'll be listed on the bank account as a director. Really, in plain English terms, we're using the director in this sense is a shorthand for company director, almost capital C, capital D, you can imagine. That's the kind of director we've been talking about on the board of directors, like a company director formally registered with ASIC. The term director is somewhat confusingly, but understandably used informally by businesses all the time to just describe someone who directs stuff. And you might be a director of operations, or you might be an executive director, or you might be the director of a team. You might even be called a managing director which sounds extremely formal, but might again just be a nice title that the organization's given you. Unless you have been formally appointed as a director and you are a company director with registered with ASIC in Australia, it is just a title, and it doesn't really have on its own being called an executive director as a job title. It doesn't on its own have any additional legal meaning. It is just what you've chosen to call the role. The one exception is pursuant to the previous question we just had. You could potentially create some confusion if you called someone an executive director and you had them attend meetings of the board and they started making big decisions on behalf of the company and controlling the bank account. ASIC could view them as a de facto company director. But in most cases, when you see people with the job title director, but they're not actually company director, it's just a job title and doesn't really carry with it any of the liability and risk that we just spoke about. So hopefully that clarifies the more colloquial director from the company director. For them to be listed with ASIC, do they need to have shares in the company? I assume you're asking about directors. For directors to be listed with ASIC, do they need to have shares in the company? The answer to that is no. You can absolutely have a director, someone who is the arms and the mind of the company, without them actually being, part of the rest of the body. And certainly in large companies, people will be appointed to the board who don't have any shares in the company, although it's fairly rare that they wouldn't at least have a small stake in the company because it helps them be a little bit more invested in their job. So no, you don't need to. Sometimes venture organizations, investors will invest in a company and then appoint somebody for a fee to be on the board who doesn't own shares in the company, and just to sort of help keep an eye and protect their investment and watch over how the company is being operated. But in most cases, particularly for small businesses, the directors, are the founders or the shareholders. So it's pretty common for them to have shares, but it's absolutely not required, and that's an important part of the separation you get with the company structure. Okay, well, that looks like all the questions that we had. So I hope people found this useful. And as I said, do feel free to reach out to our team if you have any questions or come along to our next webinar. We might wrap up now. So thank you all so much for attending, and I will see you next time. Thanks.